seems like the stock market is hitting unprecedented highs all the time in this current age. While this could be due to more young money being in the stock market than ever, more interest in hype stocks, heightened inflation rates, stimulated economy, etc. Well, that is not what this video is about. Instead, I would like to talk about my favorite type of investing and how it is affected in this current economy. The stock market is moving much quicker than the regression average right now. This isn't the best form of measurement for the stock market, but is an easy tell that the prices are trading higher than expected. Look at any graph of a weighted index meant to average the economy and see how ridiculous it looks within the past year of rapid growth. Do keep in mind there is a lot of speculations that these index funds might be a little bit in a financial bubble right now, but bear with me. All of these are great if you have a large sum of equity and you're trying to sell at a high value, but I would like to find a way to create an optimum yield that will increase every year. As you can see, this chart of S&P 500 shows the dividend yield is among the lowest it has ever been, making it an awful time to invest as a dividend investor. So how do we counter this as investors? I think we must start digging much deeper than just ETFs that are going to be as overvalued as the market, but instead focus our energy towards stocks undervalued to this market. The easiest way to judge a company's value is by looking at the PE ratio of the stock. We need to first understand what the PE ratio means for a stock. This is the price over earnings ratio that will give us a general measurement of the company's worth. Because this compares two stats that grow with a growing company, it is standardized and makes it easy to compare company to company. Almost like comparing ERA plus or WAR plus in baseball stats. We can find the value of the market by taking the PE of the S&P 500. It is currently sitting around the mid to high 30s. This is very high in comparison to historic averages. While the average goes up over a long period of time, historic averages is around 17 to 20. So we definitely don't want to buy stocks in the PE ratios in the 30s. We should be able to buy them for a much more fair price later on and hopefully get a better yield then. Each industry should have a different PE from each other, so we must keep that in mind when doing independent research. Ideally, we want stocks with lower PE ratios to minimize our risk at losing our money staked in equity and to get a better dividend yield, assuming the stock has increased value and dividend payouts. Here is an example of an undervalued stock. Please keep in mind that the banking industry as a whole has a lower PE ratio due to its slower growth and higher volatility. The PE ratio averages around a 13. Goldman Sachs is a giant bank that does very well. It usually trades around a 10 PE and is slightly undervalued currently. It is currently trading at a 7 PE. It did have a very good earnings lately and will likely not be able to keep this up for a long time without some form of resistance. But this is slightly undervalued to the industry average. If it was to have a good value, it would likely be around 405 to 410. For average or fair price, it should probably be trading closer to 415 to 425. This stock is at a high point, but undervalued in comparison to its earnings. I do already own some of these stocks. I bought in at 289 and bought a few additional shares at 308. My yield is okay, but would not buy any more stocks until it is closer to my average price. Alright, how about a stock I would buy? Look no further than Kraft Foods. Kraft is in the food and beverage industry. This industry's top performers trade typically around 25 to 30. Averages may be hard to find, but when we are talking about a $26 billion operation going on and a PE of 20, we will call this undervalued. The main concern for investors with Kraft is debt and stagnant revenue. I think the stock is headed in the right direction as it has improved earnings this year and has improved directions of cutting dividends and costs in past years to expand its distribution, optimize products to cut costs, and man more profits for revenue. While I am a dividend investor, I think Kraft cutting their dividend was the right call in this scenario. They have a large debt after merging with Heinz, and they need to be able to pay that off before they can continue to grow their company. I would consider this a good value buy as the stock could mature before taking too many more hits. I do like that the price of the stock allows a high dividend yield as well. Currently trading around a low 4% is very promising as long as the dividend won't take any more hits. I would trust a Kraft company over companies like AT&T. Now for an example of a slightly overvalued company. There is American States Water. This is a leading utility company that is an absolute dividend king, and I would love to buy some at the right price. It is currently trading at a 36.3 PE. While industry average is around 28, when it is trading higher than the S&P, you know you have an issue. So why do we buy undervalued stocks instead of holding for a correction? While this is a topic I'd like to research more and make a separate video on, this is where we start to speculate a little bit. Undervalued stocks likely won't be as affected as hard in the event of a crash or correction. After all, undervalued stocks will not have much correction needed. Regardless of all this, we are investing in companies with increasing dividends, so we are more so looking to increase our yield as much as possible. So becoming earlier adopters and letting compound interest build is helpful. With all that being said, my talk here today was pointless, as it is truthfully impossible to predict market patterns with accuracy. And with last year's economy being so funky, earnings can now be down, which will then inflate the PE ratios to higher highs. With no correction needed, we could see PE averages drop 10 points by this time next year. To me, it is important that you fill your portfolio with strong income providing stocks at a fair price than it is to cut corners. Entry points could always be better, just remember that it is a long-term game when it comes to investing. Losing 10% today could double its value in a couple of years. Remember what the great Warren Buffett says, time in the market is greater than timing the market. I just want to reinforce the importance of researching industry averages, earnings per share, revenue, year-to-year return, and all the stats involved investing before putting money in anything. Just keep investing and building wealth.